Hey guys, welcome to this video where I want to talk about how to trade sideways markets or uh, trading consolidations and ranging markets. So for me, there's basically three ways to trade a sideways market. And first, I do recognize a sideways markets in two different ways. There's a sideways market where you have a big candlestick, and then the following, let's say this is a big candlestick, and then the following candles, they're just trade or form inside the previous range of that mother bar or something. So the high of this big candlestick and the low of that candle, that's the range of the consolidation. So that would be the first way to identify a consolidation. The second way would be 2 pivot points. Okay, so if we see back here, so this is a pivot high and a pivot low, and then the following market structure or the behavior happens between those pivots, that the high one and the lower one, and we have a nice formed consolidation range back here. And we could say we are right now trading on a consolidation. We had this one, we're on live market, so it's nice to have a live example. So we have this pivot high and that pivot low, and then all the rest of the trading activity has been respecting or happening between those pivots. Okay, so we could say this is a consolidation, a ranging market. So now basically we have three ways to trade a sideways market. So the first one is a breakout. Okay, we wait for the break of this consolidation. So you can set buys. Let me go just decrease this to the minimum. Okay, so you can set buy order at the top and a sell stop order at the bottom, and wait for the breakout of the consolidation. Okay, so that's the first way to do that. For me, it's not my preferred way to trade consolidations, because a lot of times you can find yourself in a false breakout, okay, a whipsaw forming or something, fake out. So the breakout doesn't actually happen, and you find yourself inside a trade. But it's a valid way to do that. Okay, and in actually in trending markets, okay, or if you're on a trending day, you might find a lot of breakouts happening. So that might be a good way to do that. So that's the first way to trade a ranging market, the breakout. Okay, so you set a buy stop and a sell stop, and you wait for the breakout. The second way to do that is to trade inside the consolidation. Okay, now if I go back to this example right here, a breakout would have been the right way to go, because you could have placed a buy stop right there, and you get triggered into the buy stop, and you would have ended making money. The second way to trade is inside the consolidation. So you can see the price, maybe it's a low volatility day or something, and you recognize there's have not been a lot of breakouts. So every time prices goes to the top, you sell, and every time price goes to the bottom of the consolidation, you buy, and you buy and sell this consolidation. And actually it's a nice way to trade, because you know exactly where your stop loss need to be. Because if you're, let's say, if you sell limit there, so your stop loss, needs to be somewhere there. Okay, at the other part of the consolidation. So the stops are very tight, and you can get a nice risk to reward. So you place a sell limit there, and maybe a buy limit there, or something somewhere there, and you trade inside the consolidation. So that's the second way to trade sideways markets. And the last one is what is called the first retracement. So you actually wait for a breakout to happen, and after the breakout happen, you wait for the first time price go back to the ranging market. So let me just clean here. Let me clean this a little bit. Okay, so if you identify, let me zoom in a little bit. Okay, this consolidation right here. So you wait for a breakout, either to the downside or to the upside, and you do not trade the breakout itself. But once the breakout happens, you wait. Usually the ranging market becomes a supply or a demand area, or support and resistance. So if this support breaks, now it will form as a resistance. So when prices go back to that resistance, okay, after the breakout goes back, and now you can trade the continuation. Okay, the same on the long side. If you find the breakout to the upside, you wait for the first retracement to the support that now has become a demand, or that last resistance now becomes a support or a demand area. So you wait for a retracement to that area, and then you look for buying opportunities. So that's a safer way to trade the breakout, because you have the confirmation of the breakout actually happen against the breakout itself, when you can find yourself in a lot of fake outs. So now you have more confirmation. So these are like a higher probability setup. Okay, so guys, those are the 3 ways I trade breakouts or ranging or sideways markets. The breakout, buy and sell stop orders. Inside consolidation, you just buy and sell the edges. And the first retracement, after breakout actually happens, you work for the first pullback, first retracement to the breakout area, and then you trade the continuation. Guys, let me know in the comments what you think your preferred way to trade sideways markets, and let's practice this, and see you next in the next video. Bye bye.